Good afternoon. This is the Eye of the Storm podcast with the Elliott Wave weekly update for the Dow Jones Industrial Average, being recorded on Saturday, October the 25th at 2:50 p.m. Pacific Daylight Time. I'm here on the Dow Jones cash market, and I'm going to actually spend a little bit more time here, and then I'll give a quick update on the futures market. And what I want to talk about is, number one, where we are in this larger picture, and then what can we basically start to look for once we do kind of get to this a little bit longer term top that I think we're getting to. So the big picture is as follows here. And that's, again, if this is your first time looking at a podcast on the Dow from me, I start with my largest picture. And this data goes back to 1902. So I have approximately 123 years of data that I can see and then label. And how I started it was not by me. This was by R.N. Elliott himself, going back to his original works and seeing what he had labeled. And he labeled the high in 1929 and then that 29 crash and the start of the Depression as grand super cycles wave 1 and 2. Now, for me, that's just a very, 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 very large cycle. Now, granted, between grand super cycle 1 and 2 was 3 years, but this is how it began. As this whole market grew, and just in terms of like the economy grew, the money supply, everything that happened that produces this upward bias and going, and including all the different things that we've gone through. So taking into effect all of that, I started with 1, 2, because that was Elliott. And then he laid out the degrees. Again, grand supercycle, then cycle, primary, intermediate, minor, minute, minuet. So those were the ones that were set up by others, not me. Now, grand supercycle is Elliott. But then how are we going to count out that grand supercycle wave 3? Well, we're going to have 5 waves of supercycle degree within it. So, and that's how the whole building blocks things go. So again, and if we look at also just what the percentage. So in other words, the collapse from 1929 to 1932 wiped out 90% of the values of the Dow Jones, dropped 90%, just wiped out in 2 years. So, or 3 years. So again, when we're looking up our scale and we're looking at what we can look at now and what the percentage of the drop would be if we take from our current high down to these different levels, and I want to go over that as well, then to get an equivalent, a drop of 90% that doesn't wipe out the world or wipe out the United States is going to look a whole lot different, because damage is going to be done, but there's been a lot that's happened since that will likely survive, unlike what happened in 1929 to 1932. Now, that's just my opinion. So here we go. We're into this thing. We're using Elliott Wave. It's building blocks, and we have grand supercycle 1 and 2, supercycle 1 and 2, and then cycle 1 and 2, because this is the subdivisions, because now we're into a grand supercycle third wave. Inside of that's going to be 5 waves of supercycle degree, of which only 1 and 2. And now we're in supercycle wave 3 of grand supercycle wave 3. Again, we start over. Now we have cycle 1 and 2. And now we're in cycle wave 3 of supercycle wave 3 of grand supercycle wave 3. So you see how the building blocks are building. But eventually what we're going to have to finish is all of these 3s, 4s, and 5s. And that pretty much is where we're at right now. Because we're getting close, in my opinion, to finishing up a cycle degree third wave. And there's wave 2. So 1949 to the present is what I believe we're going to get ready to correct. Now, within that, we did World War II, we had come and gone. And so this was the Reconstruction. And then we had a period of deflation. We had a period of stagflation up in the 70s. And then we started to build again. but that was in a primary third. And then that was the 87 crash. So again, all these things that many thought at the time was going to destroy everything that we had didn't. This did, for sure. This one did damage, but there was enough from what we had in terms of infrastructure and just jobs and et cetera, that the whole economy, the country, and the globe could absorb it. So it was basically here, it was mortgages. So a lot of fallout, but again, there was a lot of money. There was a lot of dollars. There was a lot of things going around. Yes, large amounts were lost, no doubt, but there was still enough that pulled everything through, and the companies continued to produce. Now, again, in the great collapse, the great financial collapse of 2008, 2009, the market basically dropped 39%. And that's if we were to take it from our high. If we're just looking at from inside, it's quite a bit more. So again, all in terms of where we are. So here we go. We're back now. Now we're getting ready to finish this cycle wave 3. There's going to be 5 waves of primary degree, of which we're 1 through 4 are done. Wave 4 being the great financial collapse of 2008, 2009. In fact, folks, this was an irregular B wave in the Dow, all by itself. A regular B wave. See how the Dow went up, made a new high above wave 3, substantial new high above wave 3. The previous high was 11,750. This was 14,021. And then we dropped all the way back to, and that's actually right there, all the way back to 6,469 or 6,470. So that was a very large drop, 14,000. So it was more than 50%. Now, and then we had a total recovery. And then again, we've got to pull back out. Let me just go like this. And then our next mini disaster was the pandemic. And another fourth wave. So and I'm mentioning those because they're going to become important in my view. As we begin to do all of these threes, finishing threes, we got the 4s and the 5s to do. And what does Elliott tell us? To look back to the previous fourth wave of 1 lesser degree. So, I mean, this fourth wave, we should have been looking back to the price territory of the minor fourth wave on 1 lesser degree. And yes, we got into it, but not as deep. Not as deep. This one, being a primary, we were looking back to this one, and it did. It got as deep, went a little bit beyond. So I continue to look to fourth waves for, number one, where I think the market can go based on what Elliott left us as a guideline, that the fourth wave in motion will find its terminus in the price territory of the fourth wave of 1 lesser degree. So we just have to keep working down 1 lesser degree. And then again, as we're finishing this, okay, so we're in primary 5, of which we have 1, 2, 3, and 4 on an intermediate degree done. We're in intermediate wave 5, and now I can bring it down, and I'm going to put it on the 5-year chart. And there's the 3 and there's the 4 in intermediate degree. So we're in intermediate wave 5 of primary wave 5 of cycle wave 3. So now we go inside intermediate wave 5, and it's 5 waves of minor degree inside of it. You see building blocks, so we do the same patterns over and over and over again, and it just builds up to the next degree, to the next degree, to the next degree. 5 waves of minor degree, of which 1, 2, 3, and 4 complete. 4 completed in April of this year, April the 7th. So this is recent. Okay, here's another 4. Now we're finishing that. What's going to be inside this minor 5th wave? 5 waves of minute degree, of which I'm going to go down to the daily. We have 1, 2, 3, and 4 done. And now we're in minute wave 5 of minor wave 5 of intermediate wave 5, of primary wave 5, of cycle wave 3. We've gone now all the way backwards. We've worked it all the way down, and now we're counting it to that high. Now we get to count backwards, sort of, to find out, well, where can this thing go and how shall it drop? What's going to be? So not to think about, oh my God, we could go back now and just bring it back out here. So let's just open this up and put it out this way. So we have this fourth wave, and I haven't really actually figured that one out. But what we have, again, let's just go over this. 1929, 1932, the Dow lost 90% of its value. In 2008, 2009, the Dow lost 54% of its value. But now we've gone from even that high in 2008, the high was 14,000 plus. We're now topping 47,000. So by multiples, right? So these drops that we're going to be getting are going to seem huge percentage-wise. So again, it's not going to take very much to go back to that April low, which was 36,612. I'll round it up. So again, what is that going to be if we're looking at it? It's going to be a 21% drop. A 21% drop just takes us back to the April 2005 lows, 2025 lows, excuse me. Now, what's up next? Well, then we keep going down the line. That's the minor within intermediate wave 5. Okay, so now we have intermediate wave 4. Natural should be. Now, if we drop back to intermediate wave 4, that from the current high, so I'm using 47,327. I rounded it up a few cents. 47,327. That's the high. And we reached it on Friday. Okay, so what percentage then? If we go back to this intermediate wave 4 right here, what's the percentage? 39% drop from the current high. Down to that. Can we do it? Sure. Shall I look for it? Yes. I will look for that. But what's it going to be? Well, if we're looking at what we're going to be finishing, cycle wave 4, well, it took 76 years to get up here. So if we're just looking on some fibs, should it take between 6 and maybe 10 years to get back here? Yeah, more than likely. What can happen in 6 to 10 years? A whole bunch of things. I mean, and the possibility is that the market comes in well above that level because something changes. But if we're just have to looking out into that kind of like we don't know area, but we can base it on what's happened prior. And to think that what I'm going to do is just walk it down because the market tends to come back to fourth waves. These corrections, you'll find that I think everything gets marked to where those correction lows were. Because we're looking at, we're going to start coming down again. I'm going to go all the way back to that daily. We're going to look like we're going to start coming down. Well, people are going to look like, well, we're going to be correcting this. Well, there's the low. So everything gets projected back to that low. Options trading back to that low. What's the possibility? Well, we could get down to that level. So they're going to go look at strikes. So my point is, everything continues to trade. So this is another important factor to take. We're confronting a larger correction that's going to take more time. It's not just going to unfold in 2 weeks or 2 months or 6 months or in 2 or 3 years. I'm thinking this could roll out in phases, and within a year after it starts, could we be back here at 36? I think yes. In a shorter period of time frame, I think we can be back there. 2 things. Let's not forget, markets go up a lot faster, or markets go down a lot faster than they go up. So what took 76 years to get up to, I'm not going to think it's going to take 76 years to get back down there. I think it could take, between 6 and 10, maybe 12. But then I don't know what's going to be happening out there. So again, I go back to where I can deal. And my dealing is, it's like, okay, that to me would be point 1. when we're done and we're doing that, falling into that major, it's not like we're falling back to the previous fourth wave here. And we really would be, so I got to go up one. So that would be, yes, bare bones, that would be first, obviously. And that's 2,000 points. So if the Dow starts to drop 2,000 points, what's it going to suggest? Well, the high's in and we're dropping. We just broke the previous fourth, so that's done. That cements that high until we can get to here. And then if we break 43,000, okay, we've cemented another high. What does it do? It brings us down to here. Now, can we pause there if we get there because that's a 21% drop? Yes. Yes, you're going to be looking for some type of a correction. So, but it's going to fold out because remember, it took all these degrees to get up here. The first move out of the gate was that we're in a cycle third wave. What's going to be in that? There's going to be 5 waves of primary degree while we're in primary 5. Okay, but look what all came before it. And it took years. So again, when we turn it around, we're going back down, it's going to take time. Now, here is what my gut feeling is as well. You hear me speak about that if we have as much money as we have in the markets being traded, that is a good thing. Because the point is, it's like you don't have to all be long and sit with a long position and that's investing. No, we're trading, right? So if you're going to try to do this, be a trader. Traders buy and sell. Traders go short. Traders go long. Traders have positions and spreads and other things that they can piece together that gets them to tomorrow. That has risk, risk carried, not carried, but you can control risk with positions. So again, what my point of all this is, yes, trading is going to be as long as the money doesn't disappear. And I don't suspect that it's going to right away. So a lot will be flipping around. Keep trading. That's the first thing. Keep trading. We're going to turn, we're going to go down. That's all. We're going to go down. I'm not going to worry about everything else. I just like, oh my God, look how far down we're dropping. No, be in front of it. So in other words, it's like trade what's in front of you. Continue to work what you know how to do and make money. Instead of like, oh my God, we're down, and then be like a deer in the headlights. So again, be a trader. Now, if that's what we're wanting to be, and that's what we are considering ourselves, like to trade when things flip, and you hear me speak about it, if you also are listening to my S&P 500 and the NASDAQ, you hear me talking about, particularly my dailies and the morning reports, I talk about gamma. That's options trading. The options trading has just increased 100-fold, 200-fold. There is a lot of options, and they're really on everything. And they expire and they trade quite a bit, and you can hedge. So what's happening as we get into our markets and we're watching go up and up and up, why are they going up? Well, because we're so positive on the economy? No. We got earnings reports coming out, and that's all they're going to focus on. The earnings reports and the fact that we just have, via another class, right, treasuries, credit markets, have kind of factored in a 25 basis point decrease, right? So they're going to drop the rate by 25 basis points next Wednesday. That's what's been put into the market right now. So you can trade that, but you're also going to look at like, what happens if they don't? You can trade that as well. And you can put that into whatever your position is without touching the credit markets. So all the things that are coming up are going to happen. You can prepare for it. Now, if you're just a day trader and you're in the futures market, well, you get to come in clean every day. Every day you're walking in, it's like, all right, I have my parameters. I know what the market should be doing. I have my support. I have my resistance. I've got a path where the market can go, and you trade. Now, as long as the money continues to swirl around, then the money and the trading is going to be there. But you'll also hear me talk about it's like, oh, thin, the margin, not the thin, but the volumes are thin. And usually what that is, it's like not a, a break in the number of the trades. The traders are still there. What happens is like nobody's willing to sell it up here or nobody's willing to buy it down there. So if you got an order, it's like it gets thin, but that order will get filled, and it could accentuate a bull market, an upside market. It can accentuate a downside market as well. So, God, I'm trying to put this all together because I'm going to present a picture that's really telling us if indeed we're going to finish a cycle third wave up at the tops here, maybe 48,000, maybe 50,000, maybe. Yeah, there's still upside room. When we start to go down, there'll be a lot of trading. Now, let's take a look. We've just talked about that. That comes back normally to these fourth waves. So we have two that are up high. First one right there, it's nothing. 45,470, nothing. It's basically, 2,000 points from where we are, 3,000 points from where we are. Nothing. Then the one below that, I would suspect we will get there as well. And that's just 43,340. Okay, we're 47. That's 4,000 points away. Then we're dropping. But I would suspect that will be support, that will be support, this will be support. And when we're working downward and we're dropping in a five-wave structure, which I would anticipate, then we can pick points where, okay, maybe wave 3 comes down to here. Out of that first 5 down, wave 3 gets us to here. And we bounce and we come back. And maybe wave 5 gets us a little bit lower, or we get extended, and then we'll start heading to this level. So you'll find that the Elliott and these points that we should be getting to will start to make a little bit of sense as well. Now, so again, this one I think is going to be a little bit more major. So when we're coming down here, are we going to be finishing like intermediate wave 1 of primary wave A? Maybe. Maybe. All the corrections we'll be able to determine, but we have to let them unfold. Remember, there's the basic two structures, zigzag and flat. But there are 11 to 13 different variations in the flat family. So again, we got to wait. We got to see. But I'm telling you, I'm going to sit and start talking like these are areas the market will go to. When we're talking about, even if you're talking gamma levers, I think they will start to build stuff around these lows. Strike prices close to those lows. And we'll start to get large gamma positions, call walls, put walls, all the different things that'll start to wrap around these levels. And when they break, you're getting a hint of what's happening and where we can go next. Okay, so I want to keep going out. Let's go back to that 5-year weekly chart. So again, there's the first, there's the second, there's the third. Okay, so when we start to break here, we've got a lot of room. Yes, I think we'll find support at these price points, but the next major fourth is the intermediate fourth. Now, from the high, so again, I'm just gauging this from the high, current high at 47,000 to 320. Excuse me, 42,327 or 317, right in there. Okay, so if we come back to the intermediate fourth wave of primary wave 5, then that is a 39% drop from the current high, 39% drop. And we're just going back to the 2022 lows. Now, do I think that's going to be a significant area for the market to trade in and out of and around? Yes. I think we can get down there. We'll sit. We'll go. People think, okay, that was enough. We should rally because we will have taken back 3 years. This is October of 2022. This is October of 2025. What we're going to correct is the last 3 years. Yeah, we will. But my point is, I think we keep going, but we might bounce. And it could be a decent bounce. This is not just going to go straight down unless something truly disastrous happens. And you're as much in the loop as I am on what those possibilities could be. So it's going to be a surprise. It's going to be a blast. It's going to be whatever. And then, yeah, it could be real fearful, even to trade. But my point is going to remain. I'm okay trading as long as I know that there's enough money flipping around. It's when that dries up or goes away that trading becomes way too difficult because you just can't, because there's just nothing to push and to pull and to move things. So I'm still looking pretty good about there is enough money trading in precious metals, in the treasuries, in the equity markets, in the options markets, in the different sectors. There's just a lot of money. And we've seen it all come in. Again, I'm going to go out. This is the 5-year. I can go out and let's just go back to that maximum, right? So we got down to that 4. And what comes after that? Well, we have the pandemic low. What happens if we go back to the pandemic low from the top we just hit? That's a 62% drop. A 62% drop from the current level. Right? 47,327. So just back to there, it's a 62% drop. Do I think we're going to really? That's kind of like halfway point, because if we go all the way down to this primary fourth wave from the current high, that would be an 85% drop from the value. That's huge. 1929, 1932 is just 90%. Okay. So the crash of 87, I'm trying to remember now what the percentage was. I think it dropped from like 1,500 down to 572, 75% in a day. So again, I'm going to be looking here. It's not going to happen quick. This did, but there was a specific reason. We were in a pandemic. We couldn't go out. We couldn't work. We couldn't do anything. It was frightening. Boom, when you get fear. This, interest rates were too low. Inflation was sparking. Get your positions set up. Do you know how much was trading in there? Tons. And we got down, we made our low, and then we can rally again. Why? I remember it. One of the major houses, either Goldman or JP Morgan, announced that was a major low, majorly oversold. And boom, everybody jumped in and we started buying again. And now here we are. But we go back and we look at the force. So again, let's just kind of review. Let me bring this down to this one, where we have intermediate wave 5. So we're in intermediate wave 5 of primary wave 5 of cycle wave 3. 5 waves of minor degree inside this 5th wave of 1, 2, 3, and 4 are done. So we're in minor wave 5 up. And there'll be 5 waves of minute degree, which I believe 1, 2, and 3, and 4 are done. Now, again, just to kind of talk about up here at this high, I go back to the daily. There it is. And in terms of 1, 2, 3, 4, there is a possibility. There is a possibility that it's getting slimmer, but I'd have to break this down and look at this chart and to see if this could be moved over. And it can. And what I'm talking about is that 4th wave is not done and it's going to form an irregular B wave, which it's in the process of doing. So we do this. And we look here by adding these 1.236 and 1.382, and I get rid of everything else. Now we'll just leave them in this color because I'm just showing you where they are. 1.236 is 47,424. If we get there and we're finishing A, B, C, well, yeah, we can turn and slide back to this 4. Remember, we've got all these 4th waves, or what was marked as 4, but the A wave of this 4. The 4 would move over because it'd be a C wave. A, B, C. Irregular, you're going to be looking for, again, 1.618 coming down, which will take you below that level. So from 47 back to below 40, 45.5, let's say. That's going to be 2,000 points. Very tradable when it happens. Now, and to tell you the truth, I'm not going to go beyond that. I'm giving you the big picture, but I got to stick with what's happening more close to now. Right. So I very rarely, I won't trade off my daily chart because so much can happen in between there. A lot of money's flipping around in between here. And you can lose or make a ton right inside of all this. That's kind of my other point. The big picture is the big picture. Yep, we might get there. And yes, if I get proof or evidence that, yep, we're done and we're going to start going down, I may go look for a put spread or something here, knowing eventually it's going to come down there. So I'm not going to do it for next month. I'm not going to do it for sometime next year. I may put it out there December of 26 or beyond. Did you ever wonder why the leaps trade so heavily? This is part of it. Okay, so anyway, we can have back down to our smaller picture. There's that possibility. Otherwise, then it's going to be, we're in minute wave 5 going up, and there are going to be 5 waves of minuet degree. And chances are that it's forming a diagonal. A diagonal going up. Either it's going to be expanding or contracting. It's a triangle, expanding or contracting. But we have to connect 1 to 3 and 2 to 4 to form to see where we're headed or where we're going to hone in on. But right now, if we're looking this way, you're going to, for wherever that 3 is, I believe is going to have to come up here. We're just going to go right up through that and right up to like that. And then we get this one, which will probably come up like this. So I'm thinking, well, we have on top of that, here's the 4th. Now here's our next fibs, right? Because we have the fibs and the relationship is a 5th wave to the 1st wave. And in this case, minute wave 1 as it is compared to what minute wave 4. Now, I just need to go back out to the daily. That is minute wave 1. Folks, on that particular day, when that wave 1 was put in, the Dow was up over 3,000 points in one day. In one day. So what do? We take that 3,000 points and we connect it. Oops. We connect it to this 4 to give us the relationship between minute wave 1 and minute wave 5. Going back down to this guy. And what do we get? 618 is 48,101. What's most common? 100% equality. That's 49,714. You hear people say never going to happen. Really? Really? Did you think we would get to 47,000 when it's trading 45,500? That would have been like, hey, we've already collapsed. We've already come down that much. And then we went back and we exceeded it. Took a while, but we went back and we exceeded it, and there should still be more. So yeah. Is it possible? Yes. And we can get all the way up there. What do we got next week? Okay, so we have, let me just get that out of the way. We have coming next week, we have earnings for Apple, we have earnings for Amazon, we have earnings for Google, Meta, and Microsoft. Now, Apple's in the Dow. Google is not, but for the Dow itself, the rally will go broader. But those we are expecting. And then on Wednesday, on the 29th, we have FOMC decision day. Will they? Won't they? Could be a surprise or a surprise in either direction. Then and then we start with Apple and Amazon report on the 30th. And then we have Google reports on the 29th. So Fed Day. Microsoft on the 29th. Meta on the 29th. So we have the Fed, Google, Meta, and Microsoft. All on the 29th. Big stuff happening. Then On the 30th, I mean, it's booked. I have no idea if it's ever going to happen, but supposedly Trump and Xi are supposed to sit down and talk or have a meeting. And that is when Apple reports and Amazon reports on the 30th. So again, we have a lot going on next week and lots of activity. So can the market go up? It sure can. Can the market fall down? It sure can. Can it go fast? It sure can. All of the above. But right now, accordingly, I think we're finishing up a third. I think we can get it to here or to here, or possibly even that high. And then we correct in a fourth, which will be a three wave, and then we go up in five. Where can that five go? Can it go here? Yep, it can. Can it go full? Yeah, it can. I'm not saying it will, but if somebody said, well, can it? Sure. Whoever's going to say, no, it can never get there, I'm sorry. I'm not taking that advice. It can. Just, algorithms will be in their glory and they'll be trading. And there'll be a reason that they're going and buying or selling the futures or buying and selling an option. So a lot of trades will be put together. All right. So that's kind of the Dow. Main points that I want to make again are that I'm paying attention to the fourth waves as we start. Once we're finished and we put that high in and we're going to start to decline, I'm looking for these fourth waves to be broken, giving me more catalyst that, okay, we're done. We're not finding support there, so we're going to turn and go back up. We're not finding support there, so we're not going to turn and go back up. And then I know which degrees that we're going up to. So I'm going to use the Elliott, I'm going to use the Fibonacci, I'm going to put it all together and to come up with, gee, we're going on the path that we should start going down. Once that begins, yes, then I have something to mark. And once again, I come out and I'll start marking it accordingly. Once I get the 5 in, then I can now run it larger to get our first lines coming this way. All right, let's go over and take a quick look at the YM. Everything's pretty much the same here. This is the weekly, so we're down to that minor wave 4, which again was April the 7th of this year. And that's going to bring it down on the daily, and that's going to show you the same thing. April the 7th of this year. So from there, we're in minor wave 5 of intermediate wave 5, of primary wave 5, of cycle wave 3. So we have 1, 2, 3, and 4, same deal here. Now, again, I am just going to say I have flipped the count. So in other words, before I had an alternate. I've always have an alternate and a preferred, but the preferred count was suggesting that this fourth wave is not in yet, and that we're putting in the possibility of I had actually marked it here as a completion point for that minuet B wave. So B of the minute wave 4. Then we got this and this. And then I switched it over. So this prior was the alternate. Now it is the preferred, and what was the preferred is now the alternate. I just switched them, but I labeled them accordingly. So the alternate suggests that the fourth is not done. And that's why I just discussed with you what happened to them? They kind of went away. I put them on the Dow. I didn't put them here. So you can put those back by just running retracements from top of 3 to the bottom of 4, and then you put 1.236 and 1.382, and that'll give you here, and they're going to be right in here, that the market can come up to in an irregular B wave. So that is still a part of reality. I think if the market really starts to get there, then no. If it gets above 1.382 of this, no, then I'm going to go with this one, which is why I put it there, because this seems to be rallying pretty hard, and it is sticking to the forming of a diagonal. Otherwise, it's A, B, and this is the C wave. So 3, 4, and now we're putting in that small 5 that could get us up here. So that is still alive, and then the 4 comes over, but the consequence is pretty much the same as of getting up into these levels, that we're going to get a correction. So whether it's an irregular or we get up there in this, in a wave 3, and we turn and we correct, it should be a fair correction. And then we run up again. And that would be the one that I get a little bit, okay, are we finished? So again, we'll see. So nothing, they're pretty much the same. The Dow future trades, it's $5 a tick, and it trades, but not with the greatest volume and not with the same volume as the S&P or even the NASDAQ. So it comes in third. I think the Russell trades way more. So that's wrapping it all up. Again, leave a comment, talk, and I know there are people that have been trading from the short side in the Dow. I don't, truly, I'm not saying anything negative here. Our accounts can be different and for different reasons. I tend to just keep the trader in mind and not a position. As a trader, it's like you can trade it going up and down. You can build a position still looking for that eventual correction. And you still can be trading both directions. So again, I don't think that somebody was wrong. This is my point. I don't think people are wrong if they've already been looking for it. I think they may be early, but I don't think they're wrong. I do think the market is going to come tumbling down. Just not yet. Okay, I'm going to finish it there. And the next update again will be next week. And I will try to be more dependent upon doing them. So have a great weekend.